Hey everybody. In this video, I'm going to do a walkthrough of the Chapter 6 homework, and let's get started. Okay, so we're on question 1 here. And in this problem, we have this company floating airplanes, and the company has completed all of its journal entries, adjusting entries. So we're right at the ending point of the accounting cycle, where we've got an adjusted trial balance shown here. And this is for the month of March, and we've got contributions of $6,600 into the business. And it looks like that's just recorded in as a component of capital there. So our requirement for this problem is to prepare the income statement, statement of owner's equity, and the balance sheet. So we've got three of our three statements here. They've got the titles, they've got all the stuff. We just need to put the amounts in. So pretty simple. We're just going to be kind of copying and pasting in here. So our income statement, remember we're looking at revenues and expenses only to arrive at a net income figure. So I'm just going to go through. You know what? I'm just going to type these in because it's probably faster. So I'm just copying down up here. So this is your trial balance, and then we're just basically transposing the numbers off of the trial balance onto the income statement. 2080. And then I guess we do have to do a little math here. Let's add up all of our expenses. And I get, per my calculations, 3,300. And then to get our net income, we're going to take our revenue minus our expenses. So 5,790 minus 3,300. And I show 2,490 as the total of net income. Okay. So now we're going to prepare our statement of owner's equity. And so this is the kind of the goal here, or something to keep in mind when we're looking at an owner's equity statement is, this ending balance is what we're kind of gonna break out, just to show how we got here essentially from the prior month, more or less. So one thing I'm going to do first, because they did tell us that we had a $6,600 investment into the business. So I'm going to take 47,950 minus 6,600, and that gets me 41350. And again, because they're saying that this number includes $6,600, but let's back that out of this numbers, and then we're going to show it separately here under investments. So I'm going to put 41350. We have our net income from above. We're going to do a quick, 2,490 plus 6,600 gets us 90. And so we're going to take this plus, the beginning balance of capital plus the 90, which I show as 5,440. And then we've got one final piece of withdrawals of 1,280. So we're going to back that out. So 5,440 minus 1,280 gets us 49,160. And let's check our answer here. Great, we're looking pretty good so far. And then let's just finish this next one little piece of the problem. And I'm going to snip this so I don't have to scroll back up and down so much. Okay, and then we're just going to basically paste in off of our adjusted trial balance. All of our, remember our balance sheet is just going to show assets, liabilities, and equity, which is what we calculated our ending equity up here. So that is just going to kind of carry down accumulated depreciation. And when we're talking about, it says net equipment, we're talking about the 64, the net book value. In other words, I've said it that way in class. The only calculation we really need to do here is just to add these all up. And for my calculations, I get 80050, 800, outrageous, 80,050, 80050. And then back to pasting in the rest of the liabilities. And again, a quick little calculation here. And remember, then this, and like I said, this just carries down. And then we're going to add the equity and liabilities, or the capital there. 49,160 plus 30,890 gives us 80,80050. So that's a good sign. We're balanced with assets, and we got our meager half point for this problem. So 100%, for this problem. So yeah, not super difficult. It's really just about understanding how to kind of take the information on the trial balance and just prepare these financial statements from that, which is a really important part of accounting and or financial reporting specifically. So all right, let's look at the next problem. Okay, so question number 2. So this company has Focus Consulting, has journalized adjusting entries. We've got adjusted trial balance. We're going to prepare the closing entries using the income summary account for the month of November and create the post-closing trial balance. So now you can kind of see the journal entries here. They give us drop downs and all that. And then what we're, and just to kind of foreshadow or talk about what we're attempting to do in this kind of problem and with these closing entries, is that we want to close all the temporary accounts essentially into equity, into one account, right? Into this capital account essentially, which is equity. And so kind of smushing down, if you will, all of the components that fall under that equity umbrella. So we're going to close the draws out. We're going to close the service revenue. We're going to close the expenses and all that. And what we're going to end up with is just assets, liabilities, and equity. One, summarized equity number that includes all the components that make up that equity. And that is the closing process. So, okay, so the first thing we do is close our revenue accounts. So essentially, remember, we just want to kind of do the opposite. So currently in revenue, we have 5,660 as a credit balance. So we want to make that go to zero. And in essence, goes to zero. We're basically moving it into capital. We're using the income summary as kind of a vessel, an intermediary account to do that closing. So we want to debit service revenue to close it out or get it to go to zero, like I said. So we're going to debit that, and we're going to do the income summary account as the holding spot, if you will. I just want to check myself, make sure that those problems going. Okay, and then alternatively, all of our expenses are normal debit balances, right? And so to close those to zero, we're going to want to credit those. So, and then we're going to debit the income summary in this instance for the total of all these together. So we'll have to calculate that. But for all the pieces of it, we'll just go depreciation expense, insurance expense, interest expense, rent expense, and then telephone expense. That's all of our expenses. And I'm just going off the trial balance here. They're currently, the expenses are all debit balances, but to close those all into capital through the income summary, we need to credit those to get those to go to zero. So let me add these all up real quick. And then the sum of those all comes to 2,090. And now we're going to want to close that income summary out as well to complete the transfer. Like I said, using this income summary as a vessel, the final part on the income summary part is to close out the income summary itself into capital. And so we have got a credit balance in the income summary of 5,660, a debit balance of 2090. And so these two things combined, right, the 5,660 minus the 2,090 leaves us with 3,570 of a credit balance. And so we want to debit that, right, because this is bigger than that. And this is the same account. So when it's an increase in the income summary, this is a decrease, but the residual stands on the credit side. So now we're going to debit that to get the income summary to go to zero for the difference there of 3,570 between these two. And like I mentioned, we're going to move that into the capital account. Check myself as we go. Yeah. Okay. Looking good. And then we just want to close out the draws account. So we're going to credit the draws for 660 to get that to go to zero. And we're going to debit the capital account to reduce our equity by the same amount. And that's all of our closing entries. And again, what we're doing, we're just kind of like, we're moving all of this stuff, all these temporary accounts, we're moving those into a permanent account of the capital account, basically the equity account. And we're doing that through this income summary vessel, if you will, which is just the only time we see this is just when we're doing this movement. And the income summary will always have a zero balance. It's just like a vessel, like I said, this temporary account that you use. You increase it for, the revenues and expenses, and then you just close it out. It just passes through that account, essentially. Okay, so I'm going to snip this one here. So we've done all the adjustments now. And so what we want to do at this point is to prepare our closed trial balance. So we just copy down all of the assets and liabilities and all that. Those don't change with the closing entries, right? Those are all just already permanent accounts on the balance sheet. So I'm just copying these in from the unadjusted trial balance above. And then what does change then is capital. So, and that's what we changed through all this activity. And so kind of how we're looking at that, you want to see what the final, calculation is, though. We started with 11,800. That was our kind of beginning balance there. Then we added 5,660, right? That was what we added in. We subtracted out 2090. And if you would, this is the journal entry here, 3,570 is the difference. So we're adding to the 11,800, which is the beginning balance. We're adding the difference, which is, in essence, net income. And then we're subtracting the draws of 660. And that ends us up with 14,710. And let's see if we did things right by summing these all up. So I got 21,460 on the debit side. And I got 21,460 on the credit side. Woo. It's a good sign when your debits and credits equal. Sweet. Okay, we got 100%, and we'll move on to the next problem. Okay, problem number 3, very similar problem. We're using the income summary method here, so basically exactly the same thing we just did. So let's do it again. Okay, so closing our revenue accounts, we've got 9220, and remember it's a credit balance normally, so to get that to go to 0 and move into capital eventually through the income summary, we're going to want to debit the service revenue, and we're going to credit the income summary, and then we're going to debit the income summary here and just go through all of our expenses. So we have depreciation expense, we have insurance expense, we have interest expense, we have rent expense, we have salaries expense, and we have telephone expense. So let's just put these in, 240 and 60 and 30 and 660. Okay, and then we need to add all those together. And I got 49.50 by adding all those up. And then we're going to take the difference between the revenue and the expenses, and I got 42.70. We're going to basically put that into capital. We're dumping out the income summary, so it goes to 0. And then we're going to deposit, what was in the income summary as a net of these things above into capital. And then we're just going to close draws. I'm going to take a snip here now just because I know we're going to need to do that again. So as we're closing the draws, we're going to debit capital, and we're going to credit the draws account, and it was 3,440, so that goes to 0, and the capital is reduced by that same amount. Okay, and then again, we're just going to go down and input everything off the unadjusted trial balance, because those don't change, or the pre-close trial balance, I should say. I guess that's the adjusted trial balance, not unadjusted, just not closed yet. Oop. Okay. Okay, and then we get to the end, and the only thing what we do need to adjust or close, all the stuff we're doing here. We got a beginning balance of 24,570 before we close. Then we're gonna subtract, we're gonna add, because we did have net income, revenues exceeded expenses, so we're gonna increase our capital by 42.70. We're gonna, income summary goes to 0, and then that, like I said, gets dumped into capital, increasing it by 42.70, and then we're going to decrease it by 3,440 for the draws. And we got 25,400. And then I'm going to add all these up on the debits and credit side. So I got 3,880. Let's hit our check. Woo! Did it right. And again, the ultimate outcome of all the closing, right, is that we get rid of all these temporary accounts, which is the expenses and the draws, because that stuff only pertains to that specific period, that month of September. And then we're going to go into October, and that's where we're going to do the whole process again, and we're going to record revenues and expenses and draws and all that stuff that only pertains to October. And then once that month's done, we'll close that into capital. And then that's how that impact of all that historical activity does get carried forward. It's just carried forward as an aggregated number under capital, which is what we're doing here, aggregating those amounts and closing them. Okay, let's do it again. And one thing to note too, keep in mind that I've never, this is not a process that you actually do in the real world. Doing these income summary account, adjustments and things like that. This all happens behind the scenes in a modern accounting system, and it automatically closes these accounts, to capital essentially, when you roll accounting activity forward every month. But there's value in doing this exercise to ensure that you understand what is happening when the system does that, basically. But this is a very tedious process that is not, necessarily indicative of something that you would actually be doing manually in a modern accounting system. All right, I'm just going to go through and type all these in because I've got my snip over there. So I'm just going to pop in, copy everything down that's not going to close. And then we'll work on the capital. And that was 7540. Okay, so now let's do our closing entries. So again, we've got income summary. Oh, sorry, that should be the revenue account, which is called service revenue. Let's find it. Oh, where is it? There we go. And then income summary. And what was the total revenue? It was 17,170. And then we're going to close all of our expenses out. And we've got depreciation expense. We've got insurance expense, interest expense, rent expense. Oh, salaries expense, not salaries payable. And then telephone expense. And let's just pop all these in. So here we are crediting every expense account, which is basically, in effect, reducing it to zero to transfer it into capital via the income summary. Okay, let me add these all together. Okay, and then we're going to close the draws. And our draws was 4,080. Okay. So now we're almost done. We just need to adjust capital. So our starting balance before closing temporary accounts 21,610. Our total adjustments. Oh, you know what's funny on this? Is this the? Oh, are we using the direct method here? Oh, I'm a goober. Okay, sorry. This is the direct method version. So we're not gonna use the income summary. We're just going directly to capital, which basically has the same effect with one less. You don't have to, have that extra journal entry to close the closing entry out of the income summary into capital. It just goes directly into capital this way. But same outcome essentially. So we're going to increase capital by 17,170 for revenue. We're going to decrease capital by 7,540 for the expenses, and then we're going to decrease capital by 4,080 for the withdrawals, leaving us with 27,160. And then let's sum up. I got 48,440. Let's check ourselves. Sweet, we got 100%. Okay, so again, just to highlight the difference between the income summary method and then the direct method is that we don't use the income summary when we're doing the direct method. We just go directly to capital with all these closing entries. Okay, on to problem number 5. Bear with me for 1 sec. I want to make sure. Okay, we're good on video recording time. Okay, so now what we want to do in this problem is separate out like our total current assets, non-current assets, and then total assets and assets overall. So what we need to do that is to just kind of, separate this all out and, even just like identify first step, what are all the assets and what are the liabilities and equity, because we can't figure out current, short term, etc. if we don't know if we haven't separated those pieces out. So I'm just doing that. I'm doing this in a spreadsheet real quick. And they didn't really, this isn't the full thing. We don't have we don't have any equity showing here or anything. So they're just kind of trying to like force us to do a little work to separate out what is an asset versus not an asset. You know what I mean? Okay. So short-term assets are things like cash. Let's see what else we have here. Prepaid expenses and short-term investments. And then more long-term assets are things like the land, the factory equipment, and the office furniture. Because those are things we're depreciating. And when you're thinking about what's short-term, long-term, it's really like, what is it going to last longer than a year? That kind of is kind of the way you want to think about it. Okay, I'm just summarizing these real quick in my little spreadsheet off to the side. Okay, so what I show then for total current assets is then, like I said, cash, prepaid expenses, and short-term investments. And we know we know it's current because they're the short-term version. Not if it was just investments or long-term investments, those would be non-current, right? Okay, so I'm going to go 74,960, and then the non-current assets, the long-term stuff is the land, the equipment, factory equipment, and the office furniture. That those things are going to last longer. We're assuming they're going to last longer than 1 year. Nice. Okay, good. 100%, 1 out of 1. On to the next one. Okay, let's look at this problem here. Suppose a business has $867,000 long-term bank loan taken out December 31st. Borrowing arrangement requires business to pay $216,750 by September of 2025. Show how the business will report both current and non-current liabilities on its December 31st, 2024 balance sheet. So the total liabilities is the $867,000, and then the current portion is going to be the piece that we're going to repay within the within a year, right? So that is the $216,750. So that becomes then the piece of that $867 total that's current, and then the rest of it, $867 minus the $267,750, this is $650,250 is the non-current portion. So pretty straightforward. You just need to understand what does current versus non-current mean. The current portion of this 867 is the amount that will be repaid within the next year, and then the rest of it is all non-current. everything else that will be paid in the future. Okie dokie. Robin Accounting borrowed a $958,000 interest-free bank loan. Oh, that was pretty sweet. Interest-free. You take this, get this loan, and then I would take this money and put it into a high-yield savings account or something, right? That you can earn right now like 4.5% or something. So I'm just for the funny business of it. If you were actually able to borrow $958,000 interest free, so you don't have they just give you this money, you could take that money and invest it basically, or put it in a high yield savings account that's risk free, and you could earn about $43,000 a year on that money. So pretty sweet deal. I'd take that. Okay, but for the reality, they're just doing this to make it easier to calculate by saying interest free. Payment is agreed to be paid in 4 equal annual installments. Calculate the current non-current at December 31st. So 4 equal installments. So I'm just going to take this number of the total divided by 4. 958 divided by 4 gets 239,500. So we're saying in each of the next 4 years, you're going to have to pay back 239,500. And we took this out on January 1. Of 2024. So at December 31st, I think what they're getting at, let's just put this in and see if it makes sense. The current portion is always going to be 23,950 because that's what we're saying we're repaying in every year. 23 230, yeah, 239,500. But I think the last year would be 0 because we did repay the whole thing by then, and there's no future payment that's going to be due beyond. Or let me think about this. This was 1 payment, 2 payments. So this, let's just try it. It's a little bit confusing with their wording, but let's see how this works. So 958 in the first year that we do this, the non-current portion, so everything other than the 239,500 is 718,500. I'm gonna check myself just because. Yeah, okay. So again, this is the wording on it is a little confusing. But in the second year, we have already paid back one of those repayments, so it's 479 is now the total. And then in the third year, we will again have repaid one of those payments. So half of what's left is current, and then half of what's left is non-current. In other words, this half will be paid this year, and this half will be paid in the future year. So then when we get to the end of that next year, that's where this portion is now here. That's going to be paid the next year, and then there's nothing beyond that because that's the total. So that problem's okay. It's a little, it's a little confusing because they didn't give you like exact pay dates and all that kind of stuff. So okay, let's take a quick look at this problem here. Actually, I'm running up to my 30-minute time limit on my video recording, so I'm going to pause my video and restart recording in 1 sec. Okay, question number 8. Okay, so Renegade Landscaping's ledger includes the following. So we've got some accounts shown here with totals, and we need to do the similar thing, breaking out the current versus non-current liabilities. And the only non-current liability we're going to see here is the 13,950. It tells us it's non-current. Everything else is typically current. So I just add up all the rest of these, and I got 35,920, and that was pretty easy problem. When it comes to the liabilities, current, non-current, you really almost always will be just the non-current portion of long-term debt. Okay, for the following independent transactions, determine the amount of current and non-current liabilities. Okay. So on May 31st, we borrowed $154,900 from the bank. The entire amount is due on May 31st. So it's all due within 1 year. So the current's going to be zero. Oh, sorry. The current's going to be the total, and the non-current is going to be zero, which is what I think they're asking us to do this problem. Yeah. Okay. So KLM company purchased a small building. The down payment is $100,000. Remaining balance payable in 4 years. Annual payment $35,000. So when it comes to the liability, we started with $240,000. We paid $100,000 of cash. So our total debt after taking into account for the down payment is $140,000. And then we're going to owe this in 4 years with an annual payment of $35,000 starting next year. So the current portion is just that portion that's due next year. And then the non-current portion is the $140,000, like I just said, less the current portion. So I got $105,000. Cool. All right. Number 3, a business owner obtained an interest-free loan from a financing company. The loan was $114,000. The agreed terms of payment is 5 annual installments of $22,800. So just the current portion is the piece that's due within 1 year, and it tells us each year we're going to make 5 annual installment payments of $22,800. And then if we take the total of $114,000 minus the $22,800, we get $91,200. Okay, a business owner borrowed $11,000 from a close friend. They signed an agreement that payment will be made after 5 years. So it sounds like we have no current portion because none of it's going to be repaid within a year. And the total amount will be due after 5 years. So all of it is non-current, at this time. If we were within that payment, it was going to happen now, 5 years later, and we're within that time frame, then a portion of it could be non-current, it could be current. But right now, since it's beyond a year, all non-current. Okay. Okay, so we have these following balances. We need to prepare a classified trial balance. So, okay, let's just kind of go through our current assets listed in order of liquidity, right? Will be cash, accounts receivable, and inventory. And the sum of these is $78,600. And then we've got property, plant, and equipment. I guess we're just equipment in here. It's interesting. We have no accumulated depreciation showing, but whatever. So then we're just going to add the $78,600 and the $48,400 to get $127,000. I check that real quick. Okay, yeah. Okay. Our current. Let me snip this as we scroll down. Our current liabilities. We've got accounts payable. We've got unearned revenue, and we've got notes payable current portion, and the non-current will be notes payable non-current portion. So accounts payable is $16,400. Unearned revenue is $8,200. Current portion notes payable is $9,000. Let's do some quick math here to add these up. $33,600. And the current, that's $9,000. So adding 9,000 to 33,600. Oh, wait, sorry, that's just total non-current, which is just copying that down and then adding the current. Oh, I'm a dork. Okay, sorry. Oh no, it is 9,000. Oh, it's okay. So half is due next year, half is due, beyond that. I thought I was getting those mixed up. 33,600 plus 9,000 is 42,600, I think. And then we've got an equity account that shows us 84,400. And 42,600 plus 84,400 totals up to 127,000. That's good. Our assets equal our liabilities and equity, so that's what we want to see, per our accounting equation. So we're good there, and then we want to do working capital, current ratio, and the quick ratio. So at this point, it's just going through and calculating these out. Excuse me. And we have the figures to do this right here. I just want to see how the book exactly wants us to calculate this out. Working capital. We're going to take our current assets minus our current liabilities. So that we can see is 78,600 minus 33,600. So I show 45,000. And then the current ratio is our current assets divided by our current liabilities. So I got, let's see, how many? Okay, 2 decimal places, 2.34. And then the quick ratio is kind of more of a how do I want to say this? More of a strict definition of current assets or quick assets, I guess, if you will. So cash, basically just cash and accounts receivable, not like inventory, essentially. So just cash and accounts receivable divided by current liabilities. So 23,600 plus 27,400 divided by current liabilities, 33,600. I get 1.52 is what I got. So let's see if, hey, you got them right. That's good. I haven't actually done these ratios in a while, so they're important though. It's one of those things you look at like on an ongoing basis. That's when they become really valuable, where you can see like, okay, if our liabilities are increasing, if our current liabilities are increasing faster than our current assets, like cash and stuff, and those current liabilities need to be paid soon, even if we're increasing our business and doing all the things sales wise and stuff, we might run into a problem because current liabilities need to be paid now. And maybe if your current assets aren't going up, you're not getting enough cash in. You might end up with like a cash flow problem where you might even be doing good business, but you need to be collecting money sooner, essentially. Or, holding on to more cash or something. Okay, here's our financial accounting information. Note is payable over 3 years, and 6,000 will be paid in June 30, 2025. So out of this 18,000, 6,000 is due next year, and then the residual portion, which is 12,000 is due, beyond next year, so it'll be non-current. Yeah, okay. I'm just gonna snip this real quick. Okay, again, in order of liquidity, we have cash, accounts receivable. I think office supplies will go before inventory. We'll see if we get dinged for that. So I'm just copying these down. Oh, wait a minute, sorry. Office supplies isn't even actually in here. It's just one of the options to select. Okay, so we have cash, equipment, accounts receivable. Oh, there we go. Okay, so we want inventory. And then we want, okay, prepaid insurance. I think that prepaid insurance will come first. Let me check that. No, okay. Inventory and then prepaid insurance. There we go. And we got 7540. Prepaid insurance is 2100. Just adding these up real quick. 22,340. Okay, and then we have property, plant, and equipment. We have equipment, and we have accumulated depreciation, I believe, shown here. So that is a little more realistic than the last problem that didn't have depreciation. So 36,870. Accumulated depreciation is 740. So 36 minus 740 gets 37,930. And then our total assets, adding this all together, is, I got 60,270. What did that not like? Oh, what did I do? Oh, sorry, I just typed that in wrong. I said 38, so 368. So I got 36,130. There we go. And then adding those two together, I get 58. Excuse me, 470. There we go. Okay, current liabilities now. Sorry, bear with me. Yeah, there we go. I got my snip to look at as I scroll down. So current liabilities, we have accounts payable. We have unearned revenue. And then we have the current portion of it's payable and the non-current portion. And that's really kind of the only calculation that we had to do. And like I said earlier, or it should tell us above, 6,000 is due on the note next year, and then afterwards the rest will be due 12,000. And then the other balances are 49.40, and under revenue is 12.30. So then if we add these together, gets us 12,170. And then if we add the 12,170 to 12,000, I get 24,140. I'm gonna do a check just to, well, what did I keep up there? Just to type some 12,170. Oh yeah. Seems like it's 24,170, not 140. Little type fat fingered that one. Just a little error. Okay, so owner's equity here, or capital, that will just come off our trial balance, and it's 34,300. And then I'm gonna guess that when we add this all together, it's gonna be 58,470, 100%. Sweet. So that, as you can see, our assets equal our liabilities plus equity. We got the breakdown between current and non-current. And yeah, good to go. And that brings us to the end of that problem, question 11. And we got 100% on our homework. So thanks for following along with me. Hopefully this was helpful. And the most important thing to kind of pull out of this from like a midterm perspective is definitely the closing entries is good to know. You're going to have to do a little work on that. And then, yeah, that would current, non-current. Nothing too intense from that perspective, but I guess most of these problems kind of got to the heart of what's important in chapter 6. So hopefully it all made sense. And if you have any further questions, don't hesitate to reach out and ask me any questions, and we can jump on a call if you like, or talk about it in class. So thanks everybody. Hope you're having a great day, and we'll talk to you soon.